This is Matthew Cratter from Trader University, and today I want to answer the question, are BlockFi, Celsius, or Gemini Urn safe? If you take a look at BlockFi, for example, you've got some really nice interest rates here. Looks like they're even higher on the Celsius network. For example, here for Litecoin, you can earn 6.5% annual APY. For Bitcoin, for your first 2.5 Bitcoin, you can earn 6%. Now, these are obviously very good interest rates when you compare it to your Bank of America or Wells Fargo or other European or US bank interest rate, which are usually below 1%, usually even below 0.5%. But where I want to start today is by reminding you that before you decide that you want to earn interest on something, you have to make sure that you are holding a sound asset and that the asset itself is something that you would want to hold anyway. Perfect example of this is the Argentine peso. Interest rates are obviously very high in Argentina. Currently, it looks like you can earn roughly 30% yield in a bank account. If you're from Argentina, please correct me if I'm wrong. This looks like this is the short-term interest rate, though, as of January 2021, roughly 30% interest rate annualized in a bank account. But the problem is the Argentine peso has been losing purchasing power at a rate that's faster than 30%. This is a chart of the Argentine peso versus the US dollar. Argentine peso strength would be if the chart goes this way. Dollar strength would be if the chart goes this way. So you have a situation where you're earning probably more than 30% interest income, but the underlying value of the asset you're holding is going down by more than that. This is a similar mistake to what a lot of beginners make when they buy very high dividend yield stocks. They get paid out that dividend, then the stock drops or the stock cancels its dividend, something like that. So you first have to understand and decide for yourself whether you like the underlying asset. And you especially have to decide whether the underlying asset is going to depreciate at a rate faster than the interest rate you're earning on it. Perfect example would be Litecoin, LTC. This is one of the altcoins that has really gone nowhere. If we take a look at where it's been trading against the US dollar, it's trading at levels that it first saw in 2017. So again, this is a situation where Litecoin appreciation is this direction, US dollar appreciation is this direction. And so it's really underperformed. Looks like a lot of altcoins where there's not a lot of demand for block space. And there has been money flowing into it in the latest crypto bull market. But as a long-term holding, you're still not doing very well. And this is especially apparent if we look at the chart in terms of Bitcoin. Bitcoin is the scarcest asset in the universe, and it has these special properties. If we take a look at Litecoin versus Bitcoin, we can see that Bitcoin has been massively outperforming Litecoin for many years. And so you don't just have to, if you're going to hold a crypto asset, if you're going to earn interest income on it, the bar or the threshold or the benchmark is you could use the US dollar or whatever your local fiat currency is. But then you have to realize that Bitcoin really does appear that it's in the process of being monetized, of becoming a new store of value, and then eventually a new medium of exchange and unit of account. And so the returns that you really need to compare your returns to, whether you're trading altcoins, whether you're trading Ethereum, whether you're buying one of these altcoins and holding it for the long term and maybe earning interest income on it, what your benchmark really is, what you have to beat is Bitcoin, denominated in the terms of whether you're buying stock or real estate or Litecoin or Ethereum. And so this is one problem with these interest accounts. People get tempted by these very high yields, and then they end up losing money on the underlying asset. If you want to hold a single asset in there, in one of these accounts, for example, BlockFi, USDC, and then GUSD, these are both the two well-known stablecoins. If I had to pick a stablecoin that was linked to the US dollar, I would pick one of these. It's probably safe to be earning this interest rate in the account. I would just avoid Tether. USDT offers much higher interest rates in some of these accounts. but the underlying company is a little bit suspect. As we talked about it may not be fully backed, fully collateralized by US dollars. So this is tempting. Again, these interest rates do not compensate. If you're going to hold these, you have to realize that the US dollar, in terms of its real purchasing power, is going down by more than 8% a year. We've printed something like 40% of all the US dollars in existence have come into existence in the last 12 or 16 months. And so holding that, while it's tempting to hold US dollars and get an interest rate like this, and it may be something you decide to do, these are probably fully collateralized, fully backed, and safe. You never completely know. I would probably trust Gemini, the Gemini dollar, over USDC. That being said, I don't hold either of these. I try not to be tempted by high yields. I much rather have my money working, a small amount of money in a savings account, just sitting in regular US dollars, where I know it's safe. And then obviously a diversified portfolio. I much rather have these dollars, for example, working for me in real estate or in Bitcoin. So that's the general introduction, that you need to like the underlying asset that you're going to be holding, that you're going to be earning interest income on, and that underlying asset, you want to make sure that it's not depreciating by more than the interest rate. And so in the case of USDC and GUSD, the US dollar is actually losing purchasing power, at least recently, faster than this. And so you're not even breaking even. So let's talk a little bit more about earning interest on your Bitcoin and other cryptocurrencies. The most important thing that I emphasize in all my lectures, not your keys, not your coins. If you're not holding on to your private keys for your Bitcoin, if you are holding them in some sort of custodial solution where someone else holds your keys and has to give you permission to move your Bitcoin or withdraw it. For example, if you try to withdraw Bitcoin from BlockFi, you can't do it instantly. There's a 24 or 48 hour lag, and you basically are dependent on them. If they decide to freeze your account and not let you withdraw it for some reason, maybe U.S. authorities decide that your account should be frozen, you are in trouble. And so you're not, if you own Bitcoin in one of these accounts, you're not really holding Bitcoin. You're holding a Bitcoin IOU. The way you know that the Bitcoin is really yours is you know what your private key is, or you know what your seed recovery phrase is, or your recovery seed, I should say. And we'll talk more about that at the end of this video if you want to know how to buy and store Bitcoin the right way. So as I said, BlockFi, Gemini Urn, GBTC, Robinhood, I should add in here, PayPal. These are all Bitcoin IOUs. Also, if you hold other cryptocurrencies with them, you don't control your private key. Bitcoin, one of the great things about it, one of the amazing things about it is what's called a bearer asset. If you have it, if you control the private key, it's a little bit like gold. No one can take it away from you. Obviously, people can always take stuff away at gunpoint, but what a bearer asset means is that there's no counterparty risk, there's no settlement risk. If you buy a car using a bag of gold coins, and once that other person has the gold coins, the settlement is final. There's no way to reverse the transaction like you would be able to do with a bank or a credit card payment. So that's what I mean by no counterparty risk or settlement risk. Gold is gold. It's accepted anywhere in the world, or you can convert it to fiat anywhere in the world. And likewise for Bitcoin, it's a bearer asset. So if you hold some Bitcoin and control the private key, then it becomes a bearer asset. If you hold it in a custodial solution where someone else holds your private key for you, whether you hold it at BlockFi or Gemini, or if you even hold it on the Coinbase exchange, for example, you need to trust that custodian not to lose it, not to lose your Bitcoin or other cryptocurrency. You also need to trust them that the Bitcoin IOU, the paper IOU that they've issued to you, or the digital IOU, is backed by real Bitcoin. If Bitcoin were to move up overnight really sharply and they didn't have Bitcoin backing it, there could be a mismatch between what they owe their customers in terms of Bitcoin and what they're actually able to provide. If you decide to hold some Bitcoin at Gemini, BlockFi, Robinhood, or PayPal, or any of these companies, even Coinbase, obviously, they might decide to temporarily or permanently freeze your account. And at that point, there's not much you can do. Now, you might be completely innocent. You might be, these things are happening more and more frequently. What if some government bureaucrat decides that they think they saw you in some photograph at the U.S. Capitol rally and you weren't even there, and that now you're a domestic terrorist and you deserve to have all your accounts frozen? Well, you can obviously fight this in court and you might eventually win. But in the meantime, your Bitcoin doesn't do you any good. It's just like any other bank account that's been frozen. So again, you don't have to be guilty of any particular crime to have to worry about a government coming after you. This can happen all the time. Then you have companies like Robinhood, and who would actually want to trust a company like this after what they did with GME and AMC, and saying that one could not buy it, or one could only buy one share. And of course, they did this in service to their hedge fund masters, like Citadel and Point72. So there's the problem of companies being fundamentally dishonest and difficult to deal with. PayPal is one of these that's very famous for it, famous for freezing users' accounts, even their cryptocurrency accounts. And there's been cases where they've frozen cryptocurrency users' accounts, even though PayPal itself does allow now for people to buy and sell cryptocurrency within their walled garden. You cannot withdraw it. So again, this is another Bitcoin IOU. If you're finding this video helpful or useful, be sure to share it, and also please hit that subscribe and like button. So let's talk about BlockFi as another example. BlockFi was this initial example that we used where you could earn these nice interest rates on various cryptocurrencies. It's important to point out that that BlockFi does not, when you deposit either fiat or cryptocurrency with them, as it points out here in this FAQ, that digital asset is replaced with an obligation to return the same amount of that crypto plus any interest earned. And so again, this is a cryptocurrency IOU. BlockFi interest account, it's not covered by FDIC insurance, SIPC insurance, or other similar protections. And so there is, if they don't do their hedging correctly, there's a chance that they may not be able to pay out all of their cryptocurrency holders, especially if you get sort of a run on the bank, a virtual run on BlockFi. If we take a look at their risk disclosure as well, it talks about how they pledge, repledge, hypothecate, rehypothecate, sell, lend, and otherwise use and mingle your cryptocurrencies when you deposit it there. And so you're really subject to a lot of different counterparty risks here. If they lend out your Bitcoin that you're earning interest on with BlockFi, if they lend it out to someone who doesn't completely pay it back, even if it's over collateralized, you could still take a loss on your principal. And you just never know what could happen in this case. People ask me, is BlockFi safer than Gemini Urn or vice versa? I have no insight into this. There's no transparency. One would have to be a really high up insider at both companies in order to do a comparison. So Gemini Urn is very similar. This has been getting a lot of press. It's pretty cool because you can just go here and you can earn interest. It's very similar. You can pick your coin here and then earn interest. Example like Filecoin, for example, which seems to be spiking as a result of this. Again, these are, you have to decide whether you really want to own the underlying crypto. Filecoin has not had a very good history. If we look up Gemini Urn under support, it mentions that your funds that you deposit with Gemini Urn are not insured by Gemini, but they're held with our trusted partners. Our partners are vetted through our risk management framework, blah, blah, blah. Again, these accounts are not FDIC, SIPC, or otherwise insured. Now, it says that Gemini is currently partnering with a company called Genesis. It looks like it's Genesis Trading, and they do obviously have some sort of digital asset crime and vault insurance. You can go and read through this. The problem, though, again, is you don't have full transparency. And even if you did, it's very hard to measure these counterparty risks. And so if you want to use Gemini Urn, for example, and you want to earn that 7% on Litecoin or Filecoin, you first have to decide, is Filecoin going to go down by more than 7% a year, which it probably will. But then at a more basic infrastructure level, you have to trust not only Gemini, and I do trust Gemini. I like the Winklevoss twins. They're very smart. I think they're honest. Again, though, you have a company, lots of people working there. There can always be mistakes that happen. So you have to trust Gemini, Genesis Trading, and you have to trust their insurance coverage, whichever company is carried. In this case, it looks like it's Genesis that's responsible for it. If there's a really bad hack or bad breach of security, will there be enough insurance to make every single account whole? Maybe, maybe not. Again, we don't really have that transparency. Is this really worth earning 3% on your Bitcoin for? Again, there's no FDIC or SIPC insurance coverage for crypto accounts, whether it's Robinhood or Gemini Urn or BlockFi. Is there a loophole that might let these insurance companies off the hook? In other words, the insurance company that's insuring the deposits that are being held with Gemini's partner, Genesis Trading, will there be an act of God, quote unquote, that lets them off the hook if there's some sort of breach, for example, or maybe a tornado hits the facilities or it drops into the ocean? You never know about these things, and these are very small risks, but they're risks that everyone needs to be aware of. Also, the question: has the insurance company entered into any reinsurance contracts where they offload the insurance, and they're basically getting another company to insure what they're holding, or at least the fat tail parts of that? Can you trust those counterparties? Again, we don't even know who these counterparties are. And is all this really worth it for 3% interest on your Bitcoin or 3.5% interest? Let's say you're holding one Bitcoin right now. You got in early at 3,000 or 4,000, and you're holding it today. It's worth about $47,000. That Bitcoin in a few years, if Plan B is correct, is going to be worth close to $1 million, probably more. I think Bitcoin itself will be worth in excess of $200,000 by the end of 2021. So at that point, are you still going to be comfortable holding your Bitcoin at BlockFi, at Gemini Urn, at Robinhood, or at PayPal? If you lose a Bitcoin today, I believe the real opportunity cost is you basically lost $1 million. You didn't lose $47,000. You lost $1 million at you have to apply some time value discount to it. But nevertheless, that's your real opportunity cost, because again, if it's lost, you have to come up with $47,000 very quickly to buy a new Bitcoin. And by the time you do that, Bitcoin might be at 60,000 or 100,000. You might never get back in. So is this really worth it for a 3% yield? $1,400 a month, that's really nice. But on the other hand, Bitcoin can easily go up or down more than 3% in just a minute. And so you have to take into account all this counterparty risk, as well as what I think is a very low interest rate. I would never lend out my Bitcoin for 3%. I would charge much higher prices than that because of this opportunity cost and the risk of loss. Celsius is another one. They seem to offer even higher interest rates. They have other outside companies, their custodians, which are called Fireblocks and Prime Trust, that insure their digital assets. They say their coin loans are collateralized up to 150%, which is, it says up to 150%, so not all the coins may be over collateralized like this. Even if something's collateralized at 150%, if the asset goes down 50%, call it, you could still have a loss. There'd be a 75 cents to the dollar there. And Bitcoin can obviously easily go down 50% or more. Now, this probably won't happen, but this is the fat tail risk that you're taking. Again, Celsius wallets and deposits that are not covered by insurance. And again, you have this very scary phrase: we may lend, sell, pledge, hypothecate, assign, invest, use, commingle, that's especially a word I don't like, and otherwise dispose of assets and eligible digital assets to counterparties. So who knows where your funds ultimately end up. Celsius guys seem pretty cool. It seems like a good company. But again, I don't know. I don't know what they're doing. They could make a mistake. There could be a rogue actor at the company, and insurance might not cover everything there. So these are the risks, the counterparty risks, and also the risk of holding a depreciating asset like Filecoin or Litecoin. So these are all custodial solutions. We've talked about Robinhood, Gemini Urn, Celsius, BlockFi. I encourage people to slowly move towards self-custody. You don't need to do this overnight, but this is part of the mindset and the worldview of Bitcoin and cryptocurrency. It's really about asserting your monetary sovereignty, and you do that by holding your private key, deciding that you're an adult when it comes to your finances, and that you're not going to put your retirement funds or the fruits of your hard labor. You're not going to rely on courts of law, politicians, bureaucrats, or corporations to look out for you and protect your funds. Instead, you hold them yourself. And this is one of the great things about Bitcoin. It's very easy to store your Bitcoin yourself. It's very easy to move it around. And it has these advantages where obviously you can make a mistake if you're doing self-custody. So you want to start off very small with small amounts of money and become comfortable with it. But this is definitely the direction one should be moving. We don't want to recreate the existing financial system where there's a huge amount of counterparty risk as there is with traditional banks. So as I've said many times, I like to buy my Bitcoin using Coinbase Pro. You could also use Gemini. You could use Cash App. These are all services that allow you to withdraw your Bitcoin. I should mention I'm not being sponsored by any company anywhere. And so these are just my own opinions. I use Coinbase Pro not because they're especially great. Their customer service is terrible, though I've never had to really draw on it. But it's just like a gas station. You don't ask, is this a wonderful gas station? You just want some gas for your tank. I buy my Bitcoin at Coinbase, and I withdraw it as quickly as I can. One of the tricks is you want to deposit your cash there, ACH it in, let it sit for 5 days or whatever it takes to settle, and then you can buy your Bitcoin and immediately withdraw it. If you buy your Bitcoin right away, you've got that 5-day waiting period while the US funds settle, the US dollar funds settle, and you can't withdraw it right away, and you do have that risk. Whereas if you're just sitting there with cash in your Coinbase account waiting to buy Bitcoin, it's covered by FDIC or SIPC insurance. The US dollars are, but not the Bitcoin. So I like to buy my Bitcoin using Coinbase Pro and then withdraw it and hold it on to something like a Trezor. I really like the Model T. It's got a little better screen. These are not cheap. They're $150, $180, somewhere around that. And so they're not for everyone. If you own less than $180 worth of Bitcoin, this won't make any sense at this point, though you do have to realize that if Bitcoin does what we all think and hope it's going to do, that $150 could easily become $1,500 or $15,000. And so this is one thing to keep in mind, that at some point, if you're doing well with your cryptocurrency investing, you probably will have a significant amount of money that you need to secure. So it's important at some point to invest in a hardware wallet. I like Trezor. Cold card wallet's also good. Ledger, I don't trust. They've had many hacks. They've not done a very good job of providing security for their customers. And they've also had hacks where their customers' physical addresses have been given out, which is just unacceptable to me. So I buy my Bitcoin at Coinbase Pro. And again, we're talking about self-custody here. You buy your own Bitcoin, you withdraw it and hold it on a Trezor hardware wallet. These just plug into your computer using a USB cable. I will link to instructions how to withdraw your cryptocurrency from Coinbase here. It's very simple. You just click the withdraw button and you specify where you're sending it. You put in the public address for your Bitcoin Trezor hardware wallet, and you send it there, and it gets there just in a couple minutes, sometimes a couple seconds. It's really quite amazing. An important part of all this is also to make a backup of your hardware wallet. If it's a Trezor, I'll link to this, where you can create a recovery seed. It's going to be either a 12 or 24 word seed. And in the case that your Trezor is damaged or destroyed or stolen or lost, you can recreate your Bitcoin holding just using this 12 word phrase or 24 word phrase, and you can enter that into a new Trezor or really any hardware wallet, and it will restore your private keys to that wallet and allow you to retake control of that Bitcoin. So that's the nice thing about hardware wallets. You can actually store your Bitcoin. You could store $1 billion worth of Bitcoin using a 12-word phrase, and you could go anywhere in the world. You just need to remember those 12 words or have them written down somewhere, and you could take your funds anywhere. So this is what we mean by self-custody. This is what I'm interested. This is what I do. I actually use a multi-sig solution, so I'm using multiple hardware wallets. There's 2 out of 3 or 3 out of 4. If you just Google how I store my Bitcoin, Trader University YouTube, you can see that video. I'll also link to it below. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. I should also mention as well that I'm not interested in earning interest on my Bitcoin at this point, just because I think the upside is so large. And so I think it's a little bit of a distraction at this point. Obviously, it's nice to earn some more Bitcoin that then might go up a lot. But for me, at least, I want to keep it really simple. I'm not trading Bitcoin. I'm just slowly cost averaging into it. And I've already taken most of my position already. But as new cash arises, I try to move some into Bitcoin. I find the whole earning interest thing to be a distraction, but I hope I've presented the risks here in a balanced way and you can make a decision for yourself. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.